Welcome, everyone. We're just going to give it 1 minute to let everybody come into the webinar. So we'll get started in just a moment. Hello, and thank you all for joining us. My name is Francis Creighton, and I'm the President and CEO of the Consumer Data Industry Association. We're the trade association that represents the consumer reporting industry, including, among others, the largest credit bureaus in the country, Experian, Equifax, and TransUnion, but also an entire range of consumer reporting companies that help others make good financial decisions and good employment decisions and other things for their customers. We really think that financial education and financial literacy is among the most important things that we can all work on together. A lot of people don't understand their credit report. They don't understand what their credit score means, and they don't have a good sense of what it is that happens in a credit report and how it impacts a credit score and how those things can impact your life. Credit reports are, of course, available to everybody right now during the pandemic, as often as weekly, by going to annualcreditreport.com. And the information in that credit report then becomes kind of boiled into your credit score. And then that credit score helps you get the right pricing for a mortgage or for a credit card or a car loan or something else. So it's really important that people understand what it is, how it works, and why it matters. But it's not the only thing out there, right? Financial literacy isn't just about one particular issue that one interest group like mine is after. It's really a holistic approach to how we should be running our lives. What's the role of debt in your life? What's the role of credit? What's the role of whether you should rent a home or buy a home? How do you use those credit cards smartly so that you can get the benefit out of it and don't pay unnecessary costs? All of these things are part of what we like to call financial literacy and financial education. You know, they're not a replacement for good, solid policy that helps people achieve the, that makes sure that companies are acting in the ways that they should, legally and ethically and morally. But they really do help the system, the entire financial system, by having good consumers who know the importance of shopping, know how things work, and that they're a better customer. So we're very, very fortunate today to have a few people joining us to talk about financial literacy. Anne-Lyse Wealth is a certified public accountant who turned personal finance educator. She's a storyteller and a podcaster. Anne-Lyse is the founder of Dream of Legacy, the Plutus Award-nominated platform dedicated to inspiring millennials to live a wealthy life on their terms. After leaving her corporate job a few years ago, Anne-Lyse leveraged her 13 years of experience in finance, communications, strategy, and leadership, working at Fortune 500 companies, to start her entrepreneurial journey. She's the author of Dream of Legacy, Raising Strong and Financially Secure Black Kids, and the host of the Dreamers podcast. Her work and advice have been featured in outlets like Business Insider, Fortune, NASDAQ, Next Advisor, Time, Black Enterprise, Harvard Business Review. Yeah, that's just to name a few. I mean, she's been out there everywhere, and we're really lucky to have her. And I have a question for you, Anne-Lyse. Why is this important? Why is youth financial literacy an important topic for all of us?
Well, Francis, first of all, thank you for having me. I think it's a very important conversation, so I'm glad to be here. And as far as why is financial literacy for the youth important, I think that, you know, there are many reasons, but most importantly, it helps prevent some of the mistakes that we see a lot of people make when they're young adults. So if we start educating earlier, then we don't have to deal with people taking on more student loans that they need to because they don't have the right information. We don't have to deal with people having bad credit score because they know how to manage their credit. They know how to manage their debt. They know what investing is and how to invest in their retirement and in their future. So I think if we can start earlier, we will not necessarily completely close the wealth gap, but it's one of the tools that we need to help do that. Also, I think a lot of people, especially in underserved communities, graduate with they don't have anyone that they can go and talk to answer those questions for them. So if we can start teaching financial literacy to the youth in school, then that will help them make the best of their experience as young graduates or starting their adult lives. And also there's a very, very important statistic. 70% of generational wealth is lost by the second generation, 90% by the third. And that tells us that even when we do build the wealth, we don't do a very good job at educating. So if we can start educating the youth, then they will know how to not only maintain the wealth, but build their own wealth.
Yeah, so true. One of the things that you said really stuck with me, that financial literacy really begins at home, right? But not everyone has the good home experience where they are getting taught. And what if the family isn't particularly well educated on the smart moves? Then you just are repeating the problem over and over again. And that's why it's important that even if you're doing the right thing at home, that we're taking care of this as part of the larger curriculum that's happening out there.
Absolutely. There's most of our behaviors or attitudes towards money are learned by age 8. Mm-hmm. So it's not too early to start talking about money, because again, if the parents at home don't necessarily know much or don't have the right information, then you will start learning with the wrong information, and then you have to correct the mistakes instead of not making the mistakes because you have the information.
Exactly. So true. Let me move on, if I could, to Carmina Lass. Carmina Lass has over a decade of experience developing and implementing programs that drive economic well-being at household and community levels. Currently, Carmina serves as director of Colorado's emerging statewide Office of Financial Empowerment, which is housed in the Colorado Attorney General's office. In this role, she focuses on advancing community-informed strategies to grow the financial resilience and well-being of Coloradans. Before she was doing this job, Carmina was Chief Program Officer at the Credit Builders Alliance, an organization that we at CDIA know well, where she led the implementation of capacity building programs and services for the Alliance's national network of over 570 nonprofit, governmental, and tribal entities. So, Carmina, this year, a number of states have considered setting or expanding some form of financial literacy education requirements. 7 states now require standalone courses as a high school graduation requirement, and about 25 mandate some form of related training. What inspires states to act, and what kind of impacts can we expect? I guess what I'm asking is, how can the early on education interventions impact long-term equitable wealth building?
Yeah, thank you so much for this question, Francis, and thank you to CDIA and to my fellow panelists for the opportunity to be here today. So in Colorado, like many places across the country, we are certainly seeing the disparities across a variety of metrics of financial health that contribute to a persistent and frankly unacceptable racial wealth gap. For example, our communities of color and those with lower incomes here in Colorado are more likely to be unbanked and carry higher levels of derogatory debt. And this in turn impedes the ability to build wealth and assets, as is reflected, for example, in rates of home ownership. So the Colorado Office of Financial Empowerment was created in part to respond to some of those issues that I've just named. And to the question of how early on education interventions can really impact long-term equitable wealth building, certainly there's a critical role that they can play. And I think first it's simply about, and I guess I would also say I agree with everything that Anne-Lyse already shared about the importance of youth financial literacy. I think part of it is simply grounding young people in the concepts and vocabulary of personal finance, building that familiarity and comfort level with the lexicon so that when they're engaging with financial products and services in the future, it won't be unfamiliar and foreign, right? Many adults even feel intimidated talking with loan officers or investment officers about these topics because they don't have a grasp on some of the complicated topics and tricky jargon, honestly. I know that I can relate to that when I was in my first job where I had a retirement plan and I had to make some choices about my portfolio and felt completely intimidated by that process. So it was just at the mercy of whatever the advisor was going to tell me how, what to do. So so I think that is just a really important piece in just that building that comfort, that familiarity, so that people can really self-advocate and navigate choices. Colorado has not yet gone as far as mandating financial literacy courses, yet statute does strongly encourage school districts to adopt a personal financial literacy program as part of their curriculum. And in fact, the state has created a set of standards for what personal financial literacy looks like at different grade levels. So I think that idea of consistency is really, really critical. And I think that the other key opportunity for financial literacy for young people is to offer opportunities to build skills in that financial decision-making realm aligned with other types of critical thinking that young people are learning at this time. As adults, I think we can easily recognize that our financial decision-making is so closely aligned with our values and priorities, lifestyles, and unique financial circumstances. So the way that I manage my finances might be very different from the way that other panelists might manage their finances, and that's totally okay. So for young people, it's about teaching, rather than teaching any right way to manage money, it's about building that skill set for prioritizing resource allocation and evaluating financial choices so that they can be the most impactful. And I think the last thing I'll just say is that, all that being said, I think it's just so critical, as Anne-Lyse acknowledged, to be aware that building greater financial literacy amongst young people, is not a panacea to the issues of financial inequity that are present, nor can financial literacy in and of itself be the sole driver of an individual's ability to build wealth. There are so many other systemic and circumstantial factors at play. So, and we also just need to be cautious about overemphasizing the role that financial literacy might play in an individual's ability to succeed. We really just need to think about this holistically and as a critical component, but of a larger system where we need to be concerned about what is the marketplace offering in terms of financial products and services, what are the pathways for wealth building that are available, and then do we have the right consumer protections in place?
Yeah, Carmina, when I was doing the introduction, I made that very point that, financial literacy isn't a replacement for smart public policies that ensure that products and services are being offered in the right way. But, I mean, I'm in this business, right? And even when I go to a loan officer, I find it very intimidating, right? In the best of circumstances, it's always going to be intimidating to talk to a loan officer or somebody like that. And if you don't have the facts, I mean, I understand the market pretty well. I've been working in it for a long time. I'm a participant in it in a lot of ways. And if I'm nervous going into it, imagine what it's like for somebody who doesn't have that level of information, right? What it means is that too often people are just given the product and they say, okay, well, that's the product. And they don't ask the questions, they don't push, they don't have the tools to self-advocate to get the better product that's a better fit for them. And I think that's a big part of this. Is part of the goal here is we're not interested in just everybody taking out more credit or something else. It's about getting the right product for them and helping them self-advocate towards that product.
Yeah, exactly. And just think how much more that is also informed by your family's experiences in these situations. And if they have been negative in the past, you might have that even more of a barrier going into that situation of feeling a comfort level in talking about these things.
Yeah, totally agree. So Laura Levine really has devoted her entire career to helping people of all ages, right? This isn't just about youth, right? But helping people of all ages better understand financial services. In 2004, she became the executive director of the Jumpstart Coalition, which many people on this call are familiar with and are very fond of. The Jumpstart Coalition for Personal Financial Literacy is a Washington, D.C. based nonprofit committed to financial smarts for students, and she became the president and CEO about 10 years, 2011, right, Laura? Yeah. In 2008, Laura was appointed to the President's Advisory Council on Financial Literacy by President George W. Bush and chaired the council's Youth Committee. She's currently a member of the Experian Consumer Council, the Forbes Nonprofit Council, CNBC's Financial Wellness Council, and the Community Advisory Forum for Fifth Third Bank. And Laura, before asking you a question, I want to tell everybody who's listening that if they have questions, to please go ahead and just put them into the Q&A window underneath, because I'm hoping that this isn't just going to be me asking the questions, but that maybe there are some good questions from the field that we can take. But Laura, going to you, why is this so hard? What are the barriers to youth financial literacy?
Well, first of all, thank you, Francis, for a great introduction, and thank you for including me on this really impressive panel. It's hard to, for me, it's hard to start with the negative, but the question is so important, and it's the right thing to be asking, and so I appreciate having the opportunity to answer it. So one of the things that I think is a barrier to youth financial literacy is misinformation. And it happens all over the place, but certainly here, a couple of you and I think Carmina mentioned, talking about, how financial education is not the panacea for, financial wellness for all consumers. And I constantly hear that the financial literacy community claims it is, but I don't know anyone who actually says that. So, the whole, our atmosphere in our society is rife with misinformation. But some of the misinformation really comes down to the effectiveness of financial education. And we see reports, that, well, financial education isn't effective, or it's not effective with kids, or it really doesn't change their path. But the problem with that is that a lot of the studies, and in fact, I haven't really seen a study that covers all of the aspects that you would need to know in order to determine whether or not it's effective. And so, so we have, various mandates that everyone has mentioned, and some are for a full standalone course. Some are just, different types of requirements to have financial education. And these are all good. These are all moving in the right direction. And so we're really happy about them. But, the devil's in the details. And so some of these mandates are stronger than others. Importantly, some of these mandates are better funded than others, have better structural supports like teacher training and like resources and that sort of thing. These are all going to affect the outcome. And so we can't really assess the effectiveness of financial education without knowing what the qualities are. How well trained or well qualified is the teacher who's teaching it? What are the materials? What are, and I know we talk about, content and all of those things. If we don't know those things, it's hard to assess the effectiveness. But here's the other thing. And I think that, with financial education, one of the things is that we keep looking at high school mandates, which we agree are the priority. But think about, any subject that you learn in elementary school and you build your knowledge until you get older. And so in high school, you're sort of taking the capstone. Imagine trying to take algebra as a high school student if you didn't learn multiplication when you were in elementary school. But it's what we're trying to do with financial education. And so when we look at financial education as a high school requirement, which I'm not criticizing, I'm all for that. We have to think about, is it enough? And so I think that, certainly one of the barriers is that maybe we're not doing enough. Maybe we're not starting early enough, as some of you have mentioned. Maybe we're not putting enough structural support into the financial education to actually move the needle for these students.
Yeah, thank you for that, Laura. Really, well, we're going to come back to that topic, I think, a couple of times here. Janet Alvarez is also joining us. Janet is one of the country's most recognized bilingual financial journalists and money experts and speakers. She currently serves as the executive editor of Wise Bread, one of the largest online personal financial publications, and is a contributor at both CNBC and Telemundo. Alvarez previously served as deputy business editor of the Philadelphia Inquirer, and her work has appeared in the New York Times, Washington Post, ABC News, USA Today, MarketWatch, Bloomberg, many, many others. Last year, the Nieman Foundation for Journalism at Harvard selected Janet as a visiting fellow to pursue projects that advance racial justice and improve public health journalism in the United States. Janet, when it comes to building an equitable financial landscape, does financial literacy play a role? What is the role? But what are the other steps that we need to do to get there?
Thank you, Francis, first for inviting me. I think this is such a meritorious conversation. I'm glad we're having it. I think one of the difficult truths that we often encounter regarding financial education and financial literacy at every level and for everyone is that it is intimidating. It can be overwhelming. And it often doesn't meet people where their needs are. And for communities of color, for young people, for the underserved, the information that's presented often isn't the information that they need. It isn't the information that they're tackling with at that moment, or that grapples with the real issues and real concerns that they're managing at that day. So if we're concerned, for example, with helping people learn how to manage their 401ks and invest, I think that is commendable, that is wonderful. But it may not be the concern of somebody who's considering whether they should take out a payday loan or who can't rent an apartment because their credit is too poor. And these are real concerns, and these are the legitimate concerns of the underserved and underrepresented that are not being met. So the first step, I think, is reformulating financial education so that it meets people where they are. And it's certainly commendable to think a step further about sort of where they hope they will be the next step, but where they are at that moment, without condescension, with an honest and respectful understanding of the challenges they're facing where they are today. And that can mean somebody who might be unemployed and might be having to work multiple jobs. It might be somebody who's taking out payday loans. It might be somebody who's already severely crippled by debt and has poor credit, and tackling those issues there. Second, I agree that financial education is one component of an overall financial health and financial well-being approach that the public and private sectors have to undertake together. I think the steps that remain, again, are addressing the root causes of inequity, which are systemic and which have large underlying social components that we can't even begin to address in our conversation today. 2, developing financial products that help people lift themselves up where they are. And so can we find good alternatives to payday loans? Can we build products that help people build their credit if they have poor credit? Can we build alternative forms of investing that help people who have low income and don't have an extra $50 a week even to invest? Can we design alternatives for people who have legitimate financial need? I think that's a pressing concern. And I think that's a real challenge that the financial industry as a whole can grapple with. Third, I think loan making in general, while we've made really remarkable steps towards equity in loan making, it's still hugely inequitable. So if you're going to go apply for a mortgage tomorrow, 9 times out of 10, if you have poor credit, if you have low income, you'll be seeking alternative lenders. The largest banks still will not offer you mortgages, and you'll be facing vastly different circumstances and vastly different choices than other people. So in summation, I think that the 2 big issues are financial literacy and financial education needs to meet people where they are. And I don't think it's doing that quite yet. And that's not anybody's fault. I just think we're all quite aspirational. We all quite hope that everyone's going to invest in their 401k and build wealth and own a home and take part in the American dream in the way we aspire to. And that may not be where everyone is. But second, I think the financial products that are available to people still don't meet people where they are and still don't reflect the underlying need and the underlying necessities in our community.
Yeah, in a previous job that I had, I worked at a place called the Financial Services Roundtable, and my colleague Judy Chapa, who some of you might know, would tell me all the time that while we were very focused in our work on helping people save more in their 401k, we had a whole initiative around that. She was always reminding us that that isn't sufficient because that assumes a lot of things, that you were working in a place that has a 401k, that you're working, that you're not, that you can afford to put 5 or 10% aside. And for a lot of people, that's not the case. And sometimes when people sit in the chair I was sitting in at the time, you can't help but look at every problem through your own eyes, right? And so a big part of this is your point, Janet, is we can't just look at these problems through our own eyes, through the eyes of bankers or accountants or financial professionals, but through the eyes of the people who we're trying to help. And in your words, meet them where they are at, not where we want them to be, but where they are right now. And that sense of empathy is going to be a big part of if we're really going to make this this issue, if we're going to address this issue in a real and serious way.
Precisely. I mean, I'll give you an anecdotal example from my own life. I was raised in the inner city by a single working mom who earned minimum wages, and she worked about 20 hours a week of overtime. And even so, the choice was often, are we going to have enough for dinner, or are we going to have enough for air conditioning, where I was raised in Texas in the brutal summer heat. And often we went out, we went without air conditioning because my mom smartly thought it was better for us to have enough food than to have enough air conditioning. But the simple piece of financial literacy she could have benefited from there was an understanding that there are programs in most cities and most municipalities and states that help people with cooling and heating costs. And many people who are in working poverty don't understand that. They don't understand the resources that are available for them. That is one form of financial literacy. That is one rung in the financial empowerment scale that so many more people can take advantage of at the most basic sense, at the most basic level. And there's so many programs like that can aid the working poor that are simply not being exploited enough and not being advertised enough.
This is really a question for everybody, but I'm going to ask you, Janet, to kind of keep going and expand on this a little bit. But why do Americans have so much anxiety about their finances? I mean, what I'm trying to get at is that, we've all just lived through a major pandemic where people lost their jobs or didn't know where their job was going to be. Only 10 years after the Great Recession and everything that happened there. And, there's this idea of financial trauma, of if you come into the job market at a certain point in your life, that it's going to stay with you for your entire career, and your earnings, your lifetime earnings are going to go down and that kind of thing. So I'm really asking two things. Why do Americans have so much anxiety around finances? And then assuming that this is the underlying issue, how does financial trauma manifest and impact a person's lifelong financial standing? We'll go with you, Janet, first, and we'll move on.
I think financial trauma, and I've experienced this in my life sincerely, is something that obviously begins at a very early age, and it affects your choices in the sense that you become trapped in a mental cycle of poverty, of making choices based from the perspective of poverty or based from the perspective of financial crisis. And so you might take on more debt more easily. You might make poor financial choices in general because you're functioning from this perspective of crisis. In regards to financial trauma, I think that our country, our capitalist system, is hugely admirable. It lifts millions of people out of poverty. It gives everyone the opportunity to reach their utmost objectives in life and to maximize their potential. And we should celebrate it in every sense. But we should also recognize that the United States also has a weaker social safety net than many other developed countries do. So, for example, during the financial crisis, the European experience was, for the average worker, somewhat different than it was from the American worker. You know, the European typical average worker might have lost their job, but they received furlough pay, or there were other social safety net programs that made it easier to cope with those difficulties. We had fewer such resources in the United States. And while that helps create more entrepreneurialism in our country and helps us become more self-sufficient and celebrate our capitalist values, it also means that during times of crisis, we have less to rely on, and we can experience financial trauma more easily. So I think that's where I come back to my point is one of the critical keys in financial education, especially for those who are most vulnerable, is educating them about what resources are available for them. What social safety net components do exist? Can your church help you? Can your community food bank help you? Can social services help you? Educating people about those basic safety net components is the first step in ensuring that they have financial security and do not become subject to the sort of financial trauma we're talking about.
Laura, what do you think?
Yeah, so I think that was well said, Janet. One of the things is that, you know, in financial education, and especially how we're educating the next generation of consumers, our youth, Jumpstart recently did some focus groups with parents, and you know, which I think is so important, because if we're going to solve the problem, we have to start by listening. Too often, we, you know, in our excitement, we jump right in there, but if we don't really understand the issue, it's hard to propose the solution. So we had focus groups with parents, and one of the things, and parents that we work with, the National Parents Union, who developed these groups with parents from disadvantaged circumstances. And one of the differences, one of the takeaways for us was the parents are more motivated by fear than opportunity. And so, Francis, I think a little bit to what you were saying about, you know, at FSR, it's that like, well, you know, you save and you build wealth and there's investments and, you know, and here's how to make your life better. And that a lot of us from financial services have pointed to, you know, aspirational teaching, whereas parents, and I think this speaks to Janet saying, you know, you have to meet people where they are. We talked to a lot of parents who said, here's what motivates me. You know, I want my child to learn so that, because I don't want them to be taken advantage of by predatory, you know, providers. I don't want my child to be evicted from their home. I don't want, you know, and so parents from these less advantaged circumstances think of financial education as a protection to bad things happening, as opposed to an opportunity for a better life. It may not entirely change the lessons that we're teaching, but it certainly changes how we connect and how we approach this. And I think it's a really important thing to learn. And I will admit, we are just scratching the surface where I am at learning this, but we're very eager to learn it. And I think it's important.
Carmina, any thoughts?
Yeah, I really you know, echo everything that Laura and Janet said on this topic. I recently read a blog post put out by the National Endowment for Financial Education, and the author, scholar Chloe McKenzie, described financial trauma as a cycle of triggers and reactions to the fact that our economic system places the burden of ending or overcoming wealth inequality on the people who suffer from it most. So I think this really gets at this idea that we've acknowledged that there's these systemic issues, as Janet, you know, described really well, that are limiting the number of options of financial products available or pathways to asset building. But then that failure is attributed to the individual when they don't succeed, right? So that is what financial trauma really is that you are doing everything that you think you're supposed to, but then you are not succeeding, and you're attributing that failure to yourself. And so I think we also tend to underemphasize the fact that for communities that hold generational wealth, there is a wider margin for error there. And oftentimes, I think this financial trauma causes people to withdraw from the financial system, and bringing it back to the idea of financial literacy in education. And this is a point that you touched on, Laura, is that, you know, educators themselves are experiencing these issues, this trauma. They are themselves potentially financially unstable, right? And so how do we build confidence in the educators, who are experiencing that themselves, to be able to convey some of this information to their students? Here in Colorado, our office supports a program called Money Wiser, which provides education to K through 12 educators around how to teach personal financial literacy. And they've really found tremendous value in that they're not only teaching the academic concepts of personal financial literacy, but they're educating the educators on these concepts so that they can feel more confident, even when they might have might be experiencing financial trauma themselves.
Anne-Lyse, I know you're trying to get in here. What do you think?
Well, I think, Janet, Laura, and Carmina made some really, really great points. And I would just add to that I think one of the reasons why most Americans are stressed about their finances is because less than 70% of Americans have $400 to cover an emergency in case it were to happen. So when you are living paycheck to paycheck, when you are financially unstable and you realize that you live in a country where, even though it provides a lot of opportunities, you don't have like the social system to take care of you if something were to happen, it causes a lot of stress. And also, I deal with a lot of first generation wealth builders. And, a lot of times you just apply what you know, right? So if you grew up in a household where, taking on payday loans was the way to go, you are just going to automatically start doing that, not necessarily realizing how much you're paying in interest. And again, so that's where education comes in. And I think also it's really hard to project yourself or think that you can build wealth if you don't see that around you. And I think, a lot of times when you grow up in underserved communities, then you think with a scarcity mindset, because again, that's all you know. And it takes a lot of mindset work for people who come from a more challenging background to be able to even think that being financially stable is a possibility, that they can live a better life than living paycheck to paycheck, or that investing in the stock market is not a gamble. I hear that every day. And I think, again, it starts with education, but that can't be the end all be all. There are many more pieces to fixing the issues, and it includes also addressing systemic issues and serving the people who are those communities that have been victims of predatory lending. And there's a lot of trust issues. So it's really hard to, again, be financially stable when you have all those obstacles to overcome.
If you don't mind, I would like to jump in on something that Carmina said about teachers. And so, at Jumpstart, we're really betting on teachers. As a number of people have mentioned, there's generational wealth, there's also generational poverty. And so for those students who can't get financial learning at home, we have to reach them another way, and school is the best way. But the other thing about school is that a lot of the effectiveness comes down to the teacher. And so one of the things that we did is we have a program called Jumpstart Financial Foundations for Educators, which is professional development that raises the teacher's own level of financial literacy. So it's not just training them on how to use a product or a program, but rather, teaching them as a consumer about personal finance, because we believe that teachers are an important consumer class all by themselves. But then we studied this and we discovered that we did a study on our own program. Teachers who took our Financial Foundations course, which is an 18 to 24-hour course, improved their level of financial literacy. That translated into improvements in their own students' performance. So the classes that they took pre-training didn't do as well as the classes that they did post-training. And the students that had the biggest gains were students of color and students from low income and families that the parents had not gone to college. So it really is, I think, when we're looking at breaking down barriers and how to make this effective, bet on the teachers, because the other thing is that oftentimes, especially in public schools, teachers are part of the community that they teach. And so rather than having, volunteers, and look, and our financial institutions do wonderful things with volunteering and coming in to speak and help and volunteer, but oftentimes they don't look like the students they're talking to. The teachers in the classroom are already members of that community. And so training them to be able to convey this information when they already have the trust, or at least a higher level of trust than some of us outsiders do, I think it's an important way of breaking the cycle.
Laura, I'll just follow up on that. I think you put your finger on something really important. Without a national curriculum, right? My companies at the credit bureaus, we have a financial literacy program that they're working on, that the companies are working on. I know Ernst & Young has a really successful, I think it's called Moneyopoly. And when I was at the Roundtable, we had our Save 10 initiative. And it seems that there's a lot of interest in all of this, that there's a lot of money flowing around in this space, but that it's sort of diffused and it's a little bit all over the place, right? And so if you were the queen of the world, what would the ideal financial literacy curriculum look like? Does it begin in high school or sooner? I think you already answered that, right? It can't just be, hey, third year of high school, you get 6 weeks on financial literacy. No, it's got to be all the way through. Is it, how? What do you think? What should the ideal financial literacy curriculum look like?
Yeah. So you mean we're not already queen of the world? I mean, I'm looking at my
I was
fellow
hoping
panelists.
that I would be, but no, not yet.
So first of all, I think Carmina mentioned the standards in her state. Jumpstart is the co-publisher with the Council for Economic Education of the national standards in personal financial education, but they're voluntary standards because we publish them and states can adopt them, or they can alter them, or they can create their own. But I think that standards are really an important way of ensuring that that students who take personal finance in school are getting consistent content and and structure. And so standards are one of the important ways of doing this. I actually, Francis, see that the many organizations that are contributing resources and tools and different curricula. I think that when used within the structure of educational standards, that's really a good thing. Because first of all, it's a big country and we need lots of help to get lots of resources into the hands of schools so that schools aren't burdened with those costs. And so having a lot of participants is good. The other thing is that not all schools are the same. And so we've had schools, there is a big movement toward digital learning and, and you could, do, it's interactive and it's dynamic and how wonderful it is. But then we meet teachers who say, our school doesn't have the Wi-Fi bandwidth for me to use this product, but I still need something. So there are schools that are using, more paper-based or mechanical, or, interpersonal, like in-person interaction kind of products. And so all these contributors bring different things, to the mix. And I think the mix is important if it's done within sort of standardized objectives.
Anne-Lyse, we've just made you queen of the world. What would you do? And you're on, there you go.
Well, so I think definitely we should start as early as possible because money is such an important part of life. Why delay the education? And it could start with simple things like teaching kids, 5-year-olds, what's the difference between a want versus a need, right? Then as they get older, we can start teaching them about budgeting, saving. They definitely need to know about credit, debt management. When they get closer to going to college, they should definitely know about the impact of taking on student loans. And if they do take on student loans, what interests are, and also other ways to potentially get funding to go to college. And I also think that in high school, we should teach kids about investing, because it is a very important part of the wealth building experience. You cannot save your way to wealth. And we need to teach kids about it so that they start as early as possible, because again, with time and compound interest, the sooner you start, the better off you will be.
Carmina, we've made you, given that you are working in the Colorado state government, I'll say we've made you governor of the world. What do you think?
Yeah, I agree with what Laura and Anne-Lyse already shared, and starting early, and kind of, I think it's just important to braid these concepts in and connect them to, to other areas of learning as well. But I think what is also important to me is how we're thinking about opportunities for young people to really practice the skills that they're learning and have some kind of practical application, because I think too often we can learn these concepts, we can take the test and learn the definitions, but the reality is, as young adults, we often kind of learn, and it's trial by error a little bit. Like it really it becomes real, and you really start learning when you get that, when you open that first credit card, or you get that first bill on that credit card, and that's where you're really engaged and paying attention. So really thinking about how do we build the understanding of the concepts, but also how do we provide opportunities for young people to really practice them. And that might be in the educational setting, but that also might be programs that offer, products and, for young people, and pathways, and to open that bank account, get that going, start to have that experience where it becomes tangible and real. I think that's an important consideration.
We have a couple of questions from somebody who clicked through the Q&A tab below, which we hope everybody would do. But a couple of questions that kind of really takes this on an even deeper level, which is, sometimes these financial literacy issues stem more from our modern lifestyle and expenses and everything that, it ends up, people run out of money at the end of the month because they just don't have the income, whether that's because they're spending too much or they're not making enough, right? That the American lifestyle is an expensive lifestyle today. And then also, this person asks about predatory loans, right? Which I think on one hand, I think we would all say, the government needs to take a stronger regulatory approach to prevent those things. But I think also there's a role for financial literacy to educate people so that they understand what the downside is of using some of these predatory services. So one, talk a little bit about kind of the larger American lifestyle. I guess what I'm getting at is the power of budgeting and of understanding where you are, but then also how good financial education is a powerful tool against bad actors in the market. And why don't we go with Carmina first?
Sure. I think one challenge sometimes with financial education in respect to budgeting is that we teach to situations where everything's going right, where your income is more than the expenses that you have. And so I think there's always opportunities to really speak to that idea of resilience, of how do you plan for, yes, emergency savings, but also credit. How do you plan for when things just don't balance quite right? And I think a lot of the issues too is the timing piece of, like, how do you manage Budgeting is one thing, which is, managing your income and your expenses. Cash flow is another thing. It's managing the timing. When are bills due, and how much money do you have in your bank account at that moment? So again, I think it goes back to that idea of practical application. Like, how do we work through scenarios that are really closer to what it looks like? And then I think to the question of the predatory lending and those types of products, I think it goes back to what Janet was speaking to earlier, where part of the issue is, yes, we can regulate high cost predatory products, but regulation does not solve for the need that people have when they turn to a payday loan. And so that is about, so regulation is one part of it, but it's also about how do we point to best practices so that people can get their credit needs met sustainably and in a way that is not wealth stripping. So I think that, that consumer protection, that regulation is critical. But even in states like Colorado, where we have, really gotten rid of the traditional payday loan, there are still issues about access to credit, and there's still issues of high cost credit products. So we need to think about how the marketplace is really responding to those needs, as well as the products that are not in people's best interest.
Laura, Anne-Lyse, any thoughts? Laura, why don't we start with you, and then we'll go to Anne-Lyse.
Okay, so yeah, I think that, there are a couple of things. One of the things is that, financial decisions aren't all just knowledge-based. Sometimes they're social pressure, they're, emotionally based. There's a lot of aspects to how we make decisions. And so I think one of the things that this is, and this might be slightly off topic, but I think it's relevant in that, talking about how early should we start financial education. Well, Anne-Lyse mentioned, and I'm familiar with the study. I think you're talking about the Cambridge study about, that kids form their financial or financial related behaviors before the age of 8. And so if young children are already forming habits and behaviors at that age, we need to start raising their awareness and introducing them to financial concepts and to values and behavior attitudes, so that they are approaching their lives as adult consumers with perhaps more prudence. Because I think that sometimes some of the issues are there's a lot of advertising, and there's a lot of influence, there's a lot of things that try to part us from our money. And so having established a belief and a thought process in an early age may be some protection against those outside influences.
Thank you. Anne-Lyse?
Yes, I definitely agree with what Laura and the solutions that Laura and Carmina mentioned. I would just add maybe that if we could have some more transparency in terms of, I think a couple months ago, there was an article about two banks that were basically lending at a much lower rates to African Americans than they were to non-African Americans, without really being able to explain why that was. And so I think if there were more transparency in terms of how we are able to access credit, how that would definitely help in terms of basically knowing, okay, I don't have to go the payday loans route, because there are other opportunities out there for me to get access to credit, because I do think that the transparency would make those institutions be less careless, I would say, when it comes to lending. And again, I think it goes back to education and teaching the youth about how to manage debt and how much debt you can actually afford to take on, and what you should be saving, and when it comes to like building an emergency fund, and also what investing is and why it's important to invest, and also building how to continue to increase your income.
Well, thank you very much. Well, first of all, I've learned one thing, which is exactly how much time a fully charged laptop will last for, and it's not an hour. But I learned a lot on this. I learned a lot about making sure that when we're doing financial literacy, we can't look through our own eyes. We have to look through the people who we're trying to help educate, looking through their eyes. I learned about the importance of really meeting people where they're at, and the importance of doing this throughout life. This is lifelong learning, not just a one-time thing. I want to thank my panelists, Anne-Lyse Wealth, Carmina Lass, Laura Levine, and Janet Alvarez for being with me today. I want to also thank our team at CDIA and our partners, Lydia and Justin, Christine, Ali, and Anita for helping put this on. We thank you all so much. This is a beginning of a conversation, not the end of a conversation, and we thank you all for being a part of it. We're going to make this recording available for people, so we hope that we can reach an even larger audience. Thanks, everybody, and we'll see you again soon.
Thank you.
Thank you.